If there is one ratio you need to know as an investor is return on equity. Let us find out why this is a favorite ratio for the great investors like Warren Buffett. Hi friends, Mohan here. Investing is most intelligent only when it is most business-like. These are the famous words of Benjamin Graham, Warren Buffett's mentor. What he meant is we should never view stock as just numbers on stock exchange, but we see them as real businesses that we understand. And one simple way to understand the business is using the ratio return on equity. Return on equity is the measure of how efficient a company is making profit to its shareholders. Let's take a step back. A company is made up of asset, the sum of all the things it has, and its liability, the value of all that it owes to the others, and its equity, the remaining value to its shareholders. These three components make up a company's balance sheet. Let's say, for example, a company has a property worth $1 million. That is its asset. But then they can finance that property with a loan. Let's say $900,000 from a bank. That's its liability. So the net value of the company is not $1 million, but rather only $100,000, which is $1 million minus 900,000 loan equal to $100,000. After all, borrowing money does not make one richer, isn't it? That remaining $100,000 is the shareholders' equity. Now let's say that property is able to generate a profit of $20,000 through renting per year. It means it has made a profit of $20,000 for that year. From this information, we were able to calculate the return on equity, ROE. ROE, return on equity, equal to net profit divided by its shareholders' equity. In this case, $20,000 divided by $100,000 is equal to 20%. So return on equity is equal to 20%. ROE shows that the company is able to generate 20% more profit from that you have invested. So we can say that the higher the ROE, the more profit a company can generate from its investment. Now let's look at another example. Let's say we have two companies. One is company A and company B. Company A has an equity of $1 million and company B has an equity of $10 million. Now, both companies, let's assume, make a net income or profit of $100,000 for that year, as an example. Although both companies made the same net profit for that year, the return on equity for the company A is so much better than the return of equity of company B. This shows that company A is more efficient in producing profit for its shareholders. Company A is able to produce same profit with much lesser resources compared to company B. A steady or an increasing ROE company knows how to reinvest their earnings. This is important because most companies retain their earnings in the equity of the business. A declining ROE is a symbolic representation of a management that doesn't know how to reinvest their capital in successful businesses or assets. Companies like these is likely to pay most of its earnings as dividends to its shareholders. So in investing world, we need to look for companies that generate more ROE because it shows that the company is able to generate more profit for its shareholders. However, ROE is one of the factors in determining the efficiency of a company. And when we combine this ratio with other financial ratios, we will be able to get a clear picture of the company's strength and make better decisions from these ratios. Thanks for watching my video. If you like it, please click the like button and please subscribe and share it to your friends. And we will see you in the next video. Thank you.